Thousands of people are growing their money through US stocks right now, and you can too. And in this video I'll guide you from A to Z so you can start investing with confidence. Watch until the end of the video because I share tips that can change the way you invest. A Z Guide to Investing in US Stocks for Beginners Part 1, Introduction to the US Stock Market. The US stock market is the largest and most dynamic financial market in the world. It attracts millions of investors, from beginners to professional institutions, because it offers both opportunities and risks. For a new investor, understanding how this market works is the first essential step toward building long-term wealth. 1. What is a stock? A stock represents a unit of ownership in a company. When you purchase a stock, you become a shareholder, which means you own a small piece of that company. Your ownership gives you two main benefits: capital appreciation. If the company grows and becomes more valuable, the price of your stock increases. You can later sell at a higher price to make a profit. Dividends. Some companies share a portion of their profits directly with shareholders in the form of dividend payments. These payments are usually distributed quarterly. For example, if you buy 10 shares of Apple and Apple decides to pay a $1 dividend per share, you will receive $10 in cash. 2. Why invest in the US stock market? The United States is home to the most powerful and innovative companies across industries such as technology, healthcare, finance, and consumer goods. Investing in US stocks gives you exposure to the strongest part of the global economy. Key reasons to invest include economic power. The US economy consistently ranks as the largest in the world, supporting the growth of its corporations. Global innovation. Companies like Apple, Microsoft, Amazon, Google, and Tesla are global leaders in technology and innovation. Market transparency. US financial markets are strictly regulated by the SEC, Securities and Exchange Commission, requiring companies to disclose financial reports regularly. High liquidity. The market has millions of daily trades, which means you can easily buy or sell stocks at fair prices. Diverse opportunities. Thousands of companies are listed, covering every sector, giving investors countless choices. 3. Major U.S. stock exchanges. There are two dominant exchanges that serve as the backbone of the U.S. stock market: New York Stock Exchange, NYSE, the oldest and largest exchange, home to traditional giants such as Coca-Cola, Johnson & Johnson, and ExxonMobil. NASDAQ, famous for its focus on technology and growth companies, including Apple, Amazon, Google, Meta, and Tesla. These exchanges together represent trillions of dollars in market value and are the stage where the world's biggest companies raise capital. 4. Key market indexes. Indexes measure the performance of groups of stocks. They serve as benchmarks for investors to track overall market conditions. S&P 500 includes 500 of the largest U.S. companies. Considered the most accurate measure of the overall stock market. Dow Jones Industrial Average, DJIA, tracks 30 major companies across sectors such as finance, industry, and consumer goods. NASDAQ 100, focused on 100 of the largest non-financial companies listed on NASDAQ, heavily weighted toward technology. When investors say the market is up or the market is down, they usually refer to one of these indexes. 5. How investors make money. There are three main ways investors profit from stocks: capital gains, buying shares at a low price and selling them at a higher price; dividends, receiving cash payouts from profitable companies; compounding growth, holding strong companies for years, reinvesting dividends, and benefiting from long-term growth. Example: if you invested $1,000 in the S&P 500 index fund in 1980 and left it untouched, it would be worth over $80,000 today due to compounding. 6. Risks of stock investing. No investment is without risk, and stocks are no exception. Beginners must understand these risks before starting. Market volatility. Stock prices move up and down daily. Sudden drops can cause emotional stress. Company risk. Poor management, scandals, or falling behind competitors can destroy shareholder value. Economic risk. Interest rate hikes, inflation, recessions, or global events can negatively impact prices. Overconfidence. Beginners often chase hot tips or invest without research, which leads to losses. Managing risk is as important as seeking profit. 7. The right beginner mindset. Success in the U.S. stock market starts with building the right attitude. Think long-term, focus on steady growth, not quick gains. Research before investing. Learn how the company makes money and whether it has future potential. Accept volatility, price swings are normal. Patience is key. Continuous learning, keep improving your knowledge through books, courses, and real practice. Final thoughts on Part 1. The US stock market is an incredible opportunity for anyone willing to learn and invest carefully. By understanding what stocks are, why the market matters, and the basic risks and rewards, you are already taking the first step toward financial independence. Part 2. Basic concepts every investor must know before investing real money. Beginners need to master the basic concepts of the US stock market. These fundamentals will help you understand how the system works, make better decisions, and avoid common mistakes. 1. Stocks versus bonds versus fund. Stocks represent ownership in a company. When you buy shares, you become a partial owner. Your potential returns come from price increases and dividends. Bonds, debt instruments. When you buy a bond, you lend money to a company or government, and in return, you receive interest payments. Bonds are less risky than stocks but usually provide lower returns. Funds, investment vehicles that pool money from many investors. Two common types are mutual funds, actively managed by professionals. Exchange-traded funds, ETFs track indexes like the S&P 500 and trade like regular stocks. Understanding the difference is crucial. Stocks provide high growth potential but higher risk, while bonds provide stability. Funds give diversification and reduce individual stock risk. 2. Market capitalization. Market capitalization, market cap, is the total value of a company's outstanding shares. It is calculated by multiplying stock price by the number of shares. Large cap, companies with market cap over $10 billion, e.g., Apple, Microsoft. Safer and more stable. Mid-cap, companies between $2 billion and $10 billion. Offer growth potential with moderate risk. Small cap, companies under $2 billion. High growth potential but more volatile and risky. Market cap helps investors compare companies and build a diversified portfolio. 3. Types of stocks. Common stock gives shareholders voting rights and potential dividends. Most traded type. Preferred stock usually does not offer voting rights but provides fixed dividends and higher priority if the company faces bankruptcy. For beginners, common stock is the standard choice. 4. Bull market versus bear market. Bull market, a period when stock prices rise steadily, optimism is high, and investors are confident. Bear market, a period when stock prices fall by 20% or more, pessimism dominates, and fear spreads. Recognizing these cycles helps investors adjust their strategies and manage risk. 5. Dividends and dividend yield. Dividend, a payment from a company's profits to shareholders. Dividend yield, calculated by dividing annual dividends by stock price. For example, if a company pays $2 per share annually and the stock price is $40, the dividend yield is 5%. Income-focused investors often seek dividend-paying stocks. 6. Stock splits and reverse split. Stock split, a company increases the number of shares while lowering the price per share. Example, a 2-for-1 split turns one share priced at $200 into two shares priced at $100. Your total value stays the same. Reverse split, a company reduces the number of shares while increasing price per share. Often done by struggling companies to meet exchange requirements. Splits do not change the overall value of your holdings but can influence investor sentiment. 7. Orders and trades. When you buy or sell, you place an order through a brokerage. The main types are market order, executes immediately at the current market price. Limit order, executes only if the stock reaches a specific price you set. Stop order, triggers a buy or sell once the stock reaches a certain level. Beginners often start with market orders for simplicity but should learn to use limit and stop orders for better control. 8. Risk and diversification. Risk is an unavoidable part of investing. The best way to manage it is through diversification, spreading investments across different companies, industries, and asset classes. For example, instead of investing all your money in Tesla, you can split it across Apple, Microsoft, Johnson & Johnson, and an S&P 500 ETF. This reduces the impact of any single stock's poor performance. Final thoughts on Part 2. Mastering these basic concepts is essential before making your first investment. Once you understand what stocks are, how markets move, and how to manage risk, you will be better prepared to build a portfolio that matches your goals. Part 3. Types of U.S. stocks. Not all stocks are the same. Each type has its own characteristics, risks, and opportunities. Understanding the different categories helps investors design the right strategy for their goals. 1. Blue chip stocks. Blue chip stocks belong to large, well-established, and financially sound companies with a history of stable earnings. They are leaders in their industries and often pay regular dividends. Examples: Apple, Microsoft, Johnson & Johnson, Coca-Cola. Pros: stability, steady growth, reliable dividends, lower risk. Cons: slower growth compared to smaller companies. Blue chip stocks are ideal for beginners seeking long-term safety and moderate returns. 2. Growth stocks. Growth stocks are companies expected to grow faster than the overall market, often in technology or innovative sectors. These companies usually reinvest profits instead of paying dividends. Examples: Tesla, Amazon, Nvidia. Pros: high potential for significant capital gains. Cons: high volatility, prices can swing sharply. Growth stocks suit investors willing to accept risk in exchange for potentially higher rewards. 3. Dividend stocks. Dividend stocks regularly distribute profits to shareholders. They are popular among investors who want consistent income in addition to long-term appreciation. Examples: Procter & Gamble, Coca-Cola, AT&T. Pros: steady cash flow, potential for dividend growth over time. Cons: lower growth compared to aggressive growth companies. Dividend-paying stocks are excellent for income-focused investors and retirees. 4. Value stocks. Value stocks are companies trading below their intrinsic value. Investors buy them when the market undervalues their potential. Examples: financial or industrial firms temporarily out of favor. Pros: opportunity to buy strong companies at discount prices. Cons: stocks may stay undervalued for a long time. Value investing requires patience and belief in the company's fundamentals. 5. Penny stocks. Penny stocks trade at very low prices, typically under $5 per share, and belong to small, risky companies. Pros: potential for explosive short-term gains. Cons: extremely risky, low transparency, prone to manipulation. Beginners should generally avoid penny stocks due to their high risk of total loss. 6. Cyclical versus defensive stocks. Cyclical stocks perform well when the economy is strong but suffer during downturns. Examples include airlines, automakers, and luxury goods companies. Defensive stocks provide stable performance regardless of economic conditions. Examples include utilities, healthcare, and consumer staples. A balanced portfolio often includes both types to manage economic cycles. 7. ETFs and index funds. Instead of buying individual stocks, investors can buy exchange-traded funds, ETFs, or index funds. These funds hold a basket of stocks, offering instant diversification. Examples: SPY tracks the S&P 500. QQQ tracks the Nasdaq 100. VTI covers the total U.S. stock market. Pros: diversification, low cost, suitable for beginners. Cons: limited chance of outperforming the market. ETFs are one of the safest ways for new investors to gain exposure to the market. 8. Comparing types of stocks. Stock type: risk level, return potential, dividends. Best for blue chip, low moderate yes, long term safety, growth high rare, aggressive investors, dividend low, moderate yes, income seekers, value medium, moderate high, sometimes patient investors, penny very high, rare, speculators, ETFs/index funds, low, market average yes, beginners. Final thoughts on part 3. Knowing the types of stocks helps you decide where to put your money. A smart investor often combines several categories, for example, holding blue chip stocks for safety, growth stocks for higher potential, and ETFs for diversification. Part 4: How to open a U.S. brokerage account. Before buying your first stock, you need a brokerage account. This account acts as the gateway between you and the stock market. Setting it up is simple if you follow the right steps. 1. Choose the right brokerage. There are two main categories of brokerages: full-service brokerages, provide financial advisors, research reports, and personalized guidance. Fees are higher. Examples: Merrill Lynch, Morgan Stanley. Discount/online brokerages allow you to trade on your own with low or zero commissions. Most beginners prefer this option. Examples: Fidelity, Charles Schwab, E-Trade, Robinhood, TD Ameritrade. For most new investors, an online brokerage is the best choice due to low cost and easy access. 2. Compare brokerage features when selecting a broker. Consider the following factors: commissions and fees. Many U.S. brokers now offer $0 commissions for stock and ETF trades. Account minimums. Some brokers require a minimum deposit, but many have no minimum. Trading platform. Look for a user-friendly app or website with research tools. Customer support. Reliable support is important, especially for beginners. Investment options. Ensure the broker offers stocks, ETFs, mutual funds, and bonds. 3. Types of accounts. When opening an account, you will need to choose the type: individual brokerage account, standard account for buying and selling securities. Retirement accounts, IRA, Roth IRA offer tax advantages but have withdrawal restrictions. Margin account allows borrowing money to trade. Higher risk, not recommended for beginners. Most new investors should start with an individual cash brokerage account. 4. Steps to open an account. 1. Apply online. Go to the broker's website or app. 2. Provide personal information: full name, address, social security number, employment details, and income range. 3. Choose account type: cash or margin, individual or retirement. 4. Fund the account. Link your bank account and transfer money. 5. Verify identity. Upload documents if requested. The process usually takes less than 15 minutes. Once approved, you can start trading immediately. 5. Funding your account. Funding methods include bank transfer, ACH most common and free. Wire transfer, faster but may involve fees. Check deposit, slower, rarely used. Many brokers allow instant deposits up to a certain limit, so you can start trading before full settlement. 6. Brokerage account safety. Investors often worry about the safety of their funds. In the U.S., brokerage accounts are protected by SIPC insurance. Protects up to $500,000, including $250,000 in cash, if the brokerage fails. SEC and FINRA regulation. U.S. brokerages are heavily regulated, ensuring fair trading practices. Note: SIPC does not protect against losses due to market decline. It only covers brokerage failure. 7. Practice with a demo account. Many brokerages offer paper trading or demo accounts where you can practice with virtual money. This is a great way to learn without risking real capital. Final thoughts on Part 4. Opening a brokerage account is the first practical step toward investing. By choosing a reliable broker, understanding fees, and funding your account, you set the foundation for your investment journey. With your account ready, you can start buying U.S. stocks and ETFs. Part 5. How to analyze stocks before investing. Buying a stock without analysis is like driving without a map. To make smart decisions, investors need to understand both fundamental and technical analysis. These two approaches provide the foundation for evaluating stocks. 1. Fundamental analysis. Fundamental analysis focuses on the financial health and long-term potential of a company. Investors study financial statements, business models, and industry conditions. Key elements: revenue and earnings growth. Look for consistent growth in sales and profits over several years. Earnings per share, EPS. Net income divided by the number of outstanding shares. Rising EPS is a good sign. Price to earnings, PE, ratio, stock price divided by EPS. High PE may mean the stock is expensive or investors expect strong growth. Low PE may indicate undervaluation or weak prospects. Price to book, PB, ratio, compares stock price to book value. Helps spot undervalued companies. Debt to equity ratio measures how much debt a company uses to finance operations. Lower is generally safer. Return on equity, ROE. Net income divided by shareholder equity. Indicates profitability. Cash flow. Strong free cash flow means the company can reinvest, pay dividends, or reduce debt. Fundamental analysis helps identify strong companies worth holding for the long term. 2. Technical analysis. Technical analysis studies price movements and trading volume. Instead of focusing on financial statements, it looks at patterns and market psychology. Key tools: charts, line charts, bar charts, and candlestick charts show price history. Moving averages. Simple moving average, SMA, average price over a set period. Exponential moving average, EMA, places more weight on recent data. Support and resistance levels. Support, a price level where a stock tends to stop falling. Resistance, a price level where a stock tends to stop rising. Relative strength index, RSI, indicates if a stock is overbought, greater than 70, or oversold, less than 30. MACD, moving average convergence divergence, helps identify trend changes. Technical analysis is useful for timing trades but should not replace fundamentals for long-term investing. 3. Qualitative analysis. Numbers alone don't tell the full story. Investors also consider qualitative factors. Management quality. Strong leadership is critical for success. Competitive advantage, also called an economic moat. Does the company dominate its industry? Industry trends. Is the sector growing or shrinking? Innovation. Does the company adapt to new technology and consumer behavior? For example, Apple's moat is its brand loyalty, ecosystem, and innovation in design. 4. Combining analyses. The best investors use a mix of fundamental, technical, and qualitative analysis. Fundamentals show if a company is financially strong. Technical tools help with timing purchases or sales. Qualitative insights reveal long-term potential beyond numbers. 5. Practical example. Imagine analyzing Microsoft EMSFT, fundamental, steady revenue growth, strong cash flow, reasonable debt. Technical, stock trending above 200-day moving average, RSI at healthy levels. Qualitative, dominates software market, expanding in cloud computing. Based on this analysis, many investors would see Microsoft as a strong long-term investment. Final thoughts on Part 5. Analyzing stocks before investing reduces risk and increases confidence. Beginners should start with simple fundamentals like revenue, PE ratio, and debt levels before learning more advanced tools. Over time, combining all three types of analysis creates a solid decision-making framework. Part 6. Building your first stock portfolio. A single stock cannot make you wealthy safely. To reduce risk and grow steadily, you need a portfolio, a collection of investments that balance safety and growth. Building your first portfolio is the step that transforms you from a beginner into a real investor. 1. Understand portfolio diversification. Diversification means spreading your money across different assets so that no single investment can destroy your wealth. By sector: technology, healthcare, energy, finance, consumer goods. By market cap: large cap for stability, mid cap for growth, small cap for higher risk. By asset class: stocks, ETFs, bonds, and cash. Example: instead of investing all in Tesla, split between Apple, Johnson & Johnson, JP Morgan Chase, and an S&P 500 ETF. 2. Decide your investment goals. Your portfolio depends on your goals. Ask yourself, do you want long-term growth, retirement, wealth building? Do you want income, dividends? Do you want short-term trading, higher risk, faster profits? Clarity about goals guides every portfolio decision. 3. Risk tolerance. Risk tolerance is how much volatility you can accept without panic. Conservative investor prefers safety, chooses blue chip and dividend stocks. Moderate investor mixes stable companies with growth stocks. Aggressive investor focuses on high growth, small cap, or even speculative stocks. You should never invest in a way that keeps you awake at night. 4. Core and satellite strategy. A smart method for beginners is the core and satellite strategy. Core, stable investments such as index funds or ETFs. This provides broad market exposure. Satellite, individual stocks or sectors that you believe will outperform. Example: core equals 70% in S&P 500 ETF, SPY. Satellite equals 30% in growth stocks like Tesla or Nvidia. 5. How many stocks to own? Too few stocks equals high risk. Too many stocks equals hard to manage. For beginners, 10-20 stocks across different sectors or a few ETFs plus 5-10 stocks is a manageable start. 6. Rebalancing your portfolio over time. Some stocks will grow faster than others. This can make your portfolio unbalanced. Example, if technology grows and becomes 50% of your portfolio when your target is 30%, sell some tech stocks and buy other sectors. Rebalancing keeps your portfolio aligned with your risk tolerance. Many investors rebalance once or twice a year. 7. Dollar cost averaging, DCA. Instead of investing a lump sum, beginners can use dollar cost averaging, investing a fixed amount regularly, weekly or monthly. Example, invest $500 every month into an ETF. Benefit, reduces the impact of market volatility. Over time, you buy more shares when prices are low and fewer when prices are high. DCA builds wealth steadily without trying to time the market. 8. Avoid overtrading. Beginners often check their portfolio daily and buy or sell too often. This usually reduces returns. Focus on long-term goals. Review quarterly or semi-annually. Let compounding work for you. Final thoughts on Part 6. A strong portfolio balances safety, growth, and diversification. Start small with ETFs and a few well-known stocks, invest regularly, and avoid emotional decisions. With discipline, your first portfolio will become the foundation of long-term wealth. Part 7. Strategies for long-term versus short-term investing. There is no single way to invest in the stock market. Some investors hold stocks for decades, while others trade daily. Understanding the difference between long-term and short-term strategies helps you choose the path that fits your goals and personality. 1. Long-term investing definition. Long-term investing means buying and holding stocks or funds for many years, often 5 years or more. Benefits: compounding growth, profits reinvested over time can multiply wealth. Lower stress, less concern about daily price fluctuations. Tax efficiency. In the U.S., long-term capital gains are taxed at lower rates. Historical success. The U.S. stock market has grown steadily over decades despite short-term crashes. Best approaches: buy and hold, purchase quality companies and keep them. Index fund investing. Regularly invest in ETFs like S&P 500, SPY, or Total Market, VTI. Dividend growth investing. Focus on companies that increase dividends year after year. Example, if you invested $10,000 in the S&P 500 in 1990 and held until 2020, it would have grown to over $200,000 despite several market crashes. 2. Short-term investing definition. Short-term investing or trading involves holding assets for a few days, weeks, or months. Benefits: faster profits, can take advantage of short market moves. Flexibility, opportunity to adapt quickly to news and events. Active control, some investors enjoy the process of frequent trading. Risks: high volatility, prices can swing sharply in the short run. Higher taxes, short-term capital gains are taxed at regular income rates. Emotional stress, requires constant monitoring and discipline. Common strategies: swing trading, holding for days or weeks to capture price momentum. Day trading, buying and selling within the same day. Options trading, using contracts to speculate on price movements. 3. Which strategy should beginners choose? If you are patient and want wealth growth, long-term investing is best. If you like excitement and can handle risk, short-term trading may suit you, but only with small amounts of money. Most beginners should focus 80-90% on long-term investing and experiment with a small portion for short-term trades. 4. Blended approach. Some investors combine both, long-term portfolio as the foundation. Short-term trades with a small amount for extra opportunities. Example, 90% of funds in ETFs and blue-chip stocks, 10% reserved for swing trades. Final thoughts on Part 7. Both long-term and short-term investing can make money, but they require different mindsets. Long-term investing builds wealth steadily, while short-term trading is higher risk and requires skill. Beginners should start long-term and only add short-term strategies after gaining experience. Part 8. Common mistakes beginners must avoid. Even the best strategy can fail if you fall into common traps. Many beginners lose money not because the stock market is unfair, but because they repeat mistakes that could have been avoided. 1. Chasing hot stocks. Beginners often rush to buy stocks that are trending on the news or social media. By the time most people hear about them, the price is already inflated. Problem: buying high and selling low when hype fades. Solution: focus on fundamentals, not hype. Invest in companies you understand. 2. Lack of diversification. Putting all your money into one or two stocks is extremely risky. If one crashes, your entire portfolio suffers. Problem: overexposure to a single company or sector. Solution: spread investments across sectors and include ETFs for balance. 3. Emotional investing. Fear and greed are the biggest enemies of investors. Fear: selling during market dips. Greed: buying too much during market peaks. Solution: stick to your plan, use dollar cost averaging, and avoid impulsive trades. 4. Trying to time the market. Many beginners believe they can predict exact highs and lows. In reality, even professionals fail at perfect timing. Problem: missing long-term growth by waiting for the perfect entry. Solution: invest consistently. Time in the market is more important than timing the market. 5. Ignoring fees and taxes. Fees, small trading fees and fund expenses add up over time. Taxes: short-term gains are taxed higher than long-term. Solution: choose low-cost brokers and hold long-term whenever possible. 6. Overtrading. Checking your portfolio daily and trading too often increases costs and stress. Problem: acting on noise instead of strategy. Solution: limit reviews to monthly or quarterly unless necessary. 7. No emergency fund. Investing money you might need soon is dangerous. If an emergency comes, you could be forced to sell at a loss. Solution: keep at least 3-6 months of expenses in cash or savings before investing. 8. Ignoring research. Some beginners buy stocks just because a friend or influencer recommends them. Problem: blind investing leads to losses. Solution: do your own research, DYR. Understand the company's business model and financials. 9. Unrealistic expectations. Expecting to double your money in a few months sets you up for disappointment. Reality: the stock market grows around 8-10% per year on average. Solution: aim for steady, realistic returns. 10. Quitting too early. Many people give up after one loss or market downturn. In reality, even successful investors experience losses. Solution: think long term. Stay invested through ups and downs. Final thoughts on Part 8. Mistakes are part of learning, but avoiding these common errors will save you time and money. Focus on discipline, patience, and research. Remember, the goal is not quick riches but steady wealth building. Part 9. Tools and resources. Every investor should use. Successful investing requires more than just buying and selling stocks. Using the right tools and resources gives you information, insight, and confidence. Beginners should take advantage of both free and paid resources to improve decision-making. 1. Brokerage platforms. Your brokerage account is the most important tool. Modern platforms provide more than trading. They offer research, charts, and educational materials. Examples: Fidelity, Charles Schwab, TD Ameritrade, Robinhood, E*TRADE. Features to use: real-time quotes, watch lists, stock screeners, analyst reports. 2. Financial news websites. Staying updated helps you understand market trends and economic changes. Reliable sources: CNBC, Bloomberg, Yahoo Finance, Market Watch, The Wall Street Journal. Avoid relying on social media hype without cross-checking reliable news sources. 3. Stock screeners. A stock screener filters stocks based on criteria like P/E ratio, dividend yield, or market cap. This saves time and helps you find opportunities. Examples: Finviz, free and powerful, Yahoo Finance Screener, TradingView, Zacks Stock Screener 4. Charting tools. Charts help visualize stock price movements and technical patterns. Popular options: TradingView, user-friendly, many free features, Thinkorswim, TD Ameritrade platform, StockCharts.com. These platforms allow drawing trend lines, applying moving averages, and setting alerts. 5. Earnings and financial reports. The most trustworthy information about a company comes directly from its filings. Where to find SEC's Edgar database, official U.S. Securities and Exchange Commission website. Company investor relations pages. Reading quarterly, 10Q, and annual reports, 10K, builds deep understanding. 6. Research reports and ratings. Professional analysts often publish stock ratings, buy, hold, or sell. While you should not follow blindly, these reports provide useful insights. Examples: Morningstar, Sachs, Seeking Alpha, TipRanks. 7. Podcasts and YouTube channels. Audio and video resources help you learn on the go. Podcasts: Motley Fool Money, The Investor's Podcast, Exchanges at Goldman Sachs. YouTube channels: Graham Stephan, Andre Jick, The Plain Bagel, Educational Focus. Choose sources that explain investing fundamentals instead of pushing get-rich-quick schemes. 8. Books for beginners. Some timeless classics include The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, One Up on Wall Street by Peter Lynch, A Random Walk Down Wall Street by Burton Malkiel. Books give you deep knowledge that short articles cannot. 9. Stock simulators. Practice without risk using virtual trading apps. Examples: Investopedia Simulator, Thinkorswim Paper Trading, Wall Street Survivor. Benefit: learn by experimenting before risking real money. 10. Communities and forums. Online communities allow you to discuss ideas with other investors. Examples: Reddit, r/stocks, r/investing, Bogleheads Forum, FinTwit, Twitter Finance. Warning: always verify advice. Not all opinions are accurate. Final thoughts on Part 9. Using the right tools and resources gives you an advantage. Combine reliable news, strong charting platforms, analyst reports, and timeless books to build both knowledge and confidence. Remember, tools are helpful, but your discipline and strategy matter most. Part 10. Step-by-step guide to making your first stock purchase. Buying your first stock is an exciting milestone. With a brokerage account ready and basic knowledge in place, you can now take the practical steps to become a shareholder. 1. Fund your brokerage account before placing a trade. Ensure money is available in your account. Use a bank transfer, ACH, for free deposits. Some brokers allow instant buying power up to a limit. Confirm that funds are settled before trading larger amounts. 2. Choose the stock or ETF. Do research before selecting. Beginners often start with ETFs, broad exposure with low risk, e.g., S&P 500 ETF. Blue chip stocks, stable, well-known companies. Tip: pick a company you understand and believe in long term. 3. Decide how many shares to buy. Consider your budget. Example: if Apple trades at $150 per share and you want to invest $1,000, you can buy 6 shares. Some brokers offer fractional shares, allowing you to invest any dollar amount, e.g., $100 into Apple. This makes investing accessible even with limited capital. 4. Select order type. When placing an order, you'll need to choose market order, executes immediately at the best available price. Best for beginners. Limit order, executes only at or below the price you set. Provides more control. Stop order, becomes active once the stock hits a specific price. Useful for protecting against losses. 5. Place the order steps, using an online broker or app. 1. Log in. 2. Enter the stock ticker symbol, e.g., Apple for Apple. 3. Select buy. 4. Enter number of shares or dollar amount. 5. Choose order type, market or limit. 6. Review details carefully. 7. Click Submit Order. Your broker will confirm once the order is executed. 6. Monitor your position after purchase. Check trade confirmation for price, number of shares, and total cost. Add the stock to your watch list. Do not panic if the price fluctuates. Short-term swings are normal. 7. Decide on a holding plan before buying. Already know your plan: long-term investor, hold for years, reinvest dividends. Short-term trader, set profit targets and stop-loss orders. A plan prevents emotional decisions. 8. Keep records. Track your trades for tax reporting and personal review. Most brokers provide statements, but it's wise to keep your own notes. Date of purchase, price per share, total investment reason for buying. This helps you evaluate decisions later. Example: buying your first stock. You have $500 to invest and want to buy Microsoft MSFT. 1. Deposit $500 into your Fidelity account. 2. Research confirms Microsoft is strong. 3. Microsoft trades at $250 per share. You choose to buy 2 shares equals $500. 4. Place a market order for 2 shares. 5. The order executes at $250 each. You now own part of Microsoft. Congratulations, you are officially a shareholder. Final thoughts on Part 10. Placing your first stock order may feel intimidating, but it's straightforward with practice. Start small, learn the process, and build confidence. Over time, buying and managing stocks will become second nature. Part 11: Risk Management and Investor Psychology. Investing in the stock market always carries risk. The key to long-term success is not avoiding risk completely but learning how to manage it wisely. Equally important is understanding your own psychology, because emotions often dictate decisions more than facts. 1. Understanding risk in investing. Risk is the chance of losing money or not achieving expected returns. Types of risk include market risk, prices fall due to economic downturns. Company risk, a single company underperforms or goes bankrupt. Liquidity risk, difficulty selling a stock quickly. Inflation risk, rising costs reduce real returns. Knowing these risks helps you prepare rather than fear them. 2. The role of diversification. Diversification spreads your investments across multiple stocks, sectors, or asset classes. If one stock falls, others may balance the loss. ETFs and index funds offer instant diversification. Rule of thumb: never put more than 10% of your portfolio in a single stock. 3. Position sizing. Position sizing means deciding how much money to invest in each stock. Example: if you have $10,000, you might invest $1,000 in each of 10 different companies. This prevents a single mistake from destroying your portfolio. 4. Stop loss and take profit orders. Stop loss order automatically sells if a stock falls to a set price, limiting losses. Take profit order locks in gains once a target price is reached. Beginners often ignore these tools, but they provide essential protection. 5. Risk to reward ratio. Before investing, evaluate potential profit compared to potential loss. Example: risking $1 to possibly earn $3 equals good ratio, 1 to 3. If risk is higher than reward, reconsider the trade. 6. Psychology of investing. Emotions are powerful in investing. Common pitfalls: fear, selling too quickly during downturns. Greed, buying more than you should when prices rise. Impatience, expecting fast profits. The best investors train themselves to stay calm and follow strategy, not emotions. 7. Building discipline. Discipline means sticking to your plan even when emotions urge you to do the opposite. Review portfolio only at set times, e.g., monthly. Avoid reacting to daily news or rumors. Focus on long-term growth, not short-term noise. 8. Learning from losses. Losses are part of investing. Even Warren Buffett has lost money on certain stocks. Instead of panicking, review why the loss happened. Adjust your strategy, but don't quit. Each mistake is an opportunity to improve. Final thoughts on Part 11. Risk cannot be eliminated, but it can be managed. Success comes from balancing risk with reward, and controlling your emotions with discipline. Mastering psychology is just as important as mastering numbers. Part 12: Taxes and Regulations in the U.S. stock market. Understanding taxes and regulations is essential for every investor in the U.S. They directly impact your profits and how you manage your portfolio. Ignoring them can lead to unexpected tax bills or even legal problems. 1. Capital gains tax. When you sell a stock for more than you paid, the profit is a capital gain. The IRS taxes these gains differently depending on how long you held the stock. Short-term capital gains, holding period, less than 1 year. Taxed as ordinary income, same rate as your salary. Can be as high as 37% depending on your income bracket. Long-term capital gains, holding period, more than 1 year. Taxed at favorable rates, 0%, 15%, or 20% depending on income. Encourages long-term investing. Example, buy stock at $1,000, sell at $1,500. Profit equals $500. If held under 1 year, taxed at income rate. If held over 1 year, taxed at 15% or lower for most investors. 2. Dividends. Tax dividends are payments from companies to shareholders. Qualified dividends, taxed at long-term capital gains rates. Ordinary dividends, taxed as regular income. Most dividends from U.S. corporations are qualified, meaning lower tax rates for investors. 3. Tax loss harvesting. If you sell a stock at a loss, you can use that loss to reduce your taxable gains. Example, gain $1,000 on stock A, lose $600 on stock B. You only pay taxes on $400 of net gain. This strategy is common for reducing tax bills. 4. Wash sale rule. Be careful, if you sell a stock at a loss and buy the same stock, or a very similar one, within 30 days, the IRS will not allow you to claim that loss for taxes. This is called the wash sale rule. 5. Retirement accounts and tax benefits. Certain accounts help investors reduce or delay taxes. 401k, employer-sponsored retirement plan. Contributions reduce taxable income. Traditional IRA, contributions are tax-deductible, growth is tax-deferred. Roth IRA, contributions are after tax, but withdrawals in retirement are tax-free. Using these accounts can save thousands in taxes over a lifetime. 6. Regulations. You must know the U.S. stock market is highly regulated to protect investors. Key organizations include SEC, Securities and Exchange Commission oversees securities markets and protects investors. FINRA, Financial Industry Regulatory Authority, regulates brokerage firms and brokers. FDIC and SIPC provide insurance for cash and securities in brokerage accounts, up to limits. These bodies ensure fair trading and protect against fraud. 7. Pattern day trader rule. If you make more than 4 day trades, buy and sell the same stock in 1 day, within 5 business days, and your account is under $25,000, you may be flagged as a pattern day trader. Requirement: must maintain $25,000 minimum balance. Designed to prevent beginners from excessive risky trading. 8. Reporting taxes. Every year, brokers provide a 1099 form summarizing your gains, dividends, and interest. You must report this information to the IRS when filing taxes. Failure to do so can lead to penalties and audits. Final thoughts on Part 12. Taxes and regulations are not the most exciting part of investing, but they are critical. By understanding the rules, you protect your profits and avoid unnecessary penalties. Smart investors always factor taxes into their strategy. Part 13. Advanced strategies, options, REITs, and bonds. Once you understand the basics of stocks, you may want to explore advanced strategies to expand your portfolio. These tools provide opportunities for diversification, income, and risk management. However, they require careful learning before use. 1. Options. Trading options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price before a set date. Call option, right to buy at a fixed price. Used if you expect the stock to rise. Put option, right to sell at a fixed price. Used if you expect the stock to fall. Benefits: leverage, control more shares with less capital. Hedging, protect portfolio against losses. Risks, can lose 100% of your investment if options expire worthless. Requires precise timing and market knowledge. Tip: beginners should not trade options until mastering basic investing. 2. Covered calls. One popular beginner-friendly option strategy is the covered call. You own shares of a stock. You sell call options on those shares to earn premium income. If the stock rises above the strike price, you may have to sell your shares, but you still profit. This strategy works well for generating income on long-term holdings. 3. Real estate investment trusts, REITs. REITs are companies that own or finance real estate properties. They trade like stocks on major exchanges. Equity REITs own income-producing properties, malls, apartments, offices. Mortgage REITs provide financing for real estate, earning interest. Benefits: regular dividends. REITs must pay at least 90% of taxable income to shareholders. Easy way to invest in real estate without owning property. Adds diversification to stock-heavy portfolios. Risks: sensitive to interest rates. Property market downturns affect returns. 4. Bonds are loans you give to governments or corporations in exchange for regular interest payments and return of principal at maturity. Treasury bonds, issued by the U.S. government. Very safe, but lower returns. Corporate bonds, issued by companies. Higher risk, higher yield. Municipal bonds, issued by states or cities. Often tax-free at the federal level. Benefits: more stable than stocks. Provide predictable income. Good hedge during stock market downturns. Risks: inflation reduces real returns. Companies or governments could default, rare in U.S. Treasuries. 5. Asset allocation with advanced tools. By mixing stocks, REITs, and bonds, you create a balanced portfolio. Young investors, more stocks, fewer bonds. Older investors, more bonds and REITs for stability and income. A classic rule is the 60-40 portfolio, 60% stocks, 40% bonds, but it can be adjusted depending on age and goals. 6. Caution for beginners: advanced tools are powerful, but misuse can lead to big losses. Always start small. Use simulated accounts to practice. Never invest money you cannot afford to lose. Final thoughts on Part 13: Options, REITs, and bonds open new opportunities beyond traditional stocks. Used wisely, they can provide income, stability, and diversification. But they require patience, education, and discipline before implementation. Part 14: Case studies of successful investors. Learning from real-world examples helps you understand how strategies work in practice. These case studies show how legendary investors approached the U.S. stock market and built long-term wealth. 1. Warren Buffett. The power of value investing. Warren Buffett, CEO of Berkshire Hathaway, is often called the greatest investor of all time. Strategy: buy high-quality companies at a fair price. Hold them for decades. Focus on businesses with strong competitive advantages, moats. Example: Buffett invested in Coca-Cola in 1988 when others doubted the company's future. Today, it remains one of Berkshire's largest holdings, producing billions in dividends. Lesson: long-term patience and belief in strong businesses beat short-term trading. 2. Peter Lynch. Invest in what you know. Peter Lynch managed the Fidelity Magellan Fund, 1977-1990, achieving an average annual return of 29%. Strategy: look for 10-baggers, stocks that increase 10x. Invest in companies you personally understand. Mix growth stocks with solid fundamentals. Example: he discovered Dunkin' Donuts as a consumer before Wall Street paid attention. This personal insight led to a highly profitable investment. Lesson: pay attention to everyday life. Some of the best investment ideas are around you. 3. Ray Dalio. The importance of diversification. Ray Dalio founded Bridgewater Associates, one of the world's largest hedge funds. Strategy: build an all-weather portfolio that performs well in any economic environment. Diversify across asset classes, stocks, bonds, commodities. Focus on risk-parity balance, not just growth. Lesson: proper diversification reduces risk while maintaining steady returns. 4. Cathie Wood. Innovation and disruption. Cathie Wood, founder of ARK Invest, focuses on high-growth, disruptive companies. Strategy: invest in future technologies, AI, genomics, electric vehicles, fintech. High conviction in long-term innovation despite short-term volatility. Example: ARK invested heavily in Tesla when many doubted its future. That bold decision produced huge gains. Lesson: innovation brings high risk but also potential for massive rewards. 5. John Bogle. Simplicity wins. John Bogle, founder of Vanguard, created the first index fund. Strategy: most investors should use low-cost index funds instead of picking stocks. Don't look for the needle in the haystack. Just buy the haystack. Example, the Vanguard S&P 500 Index Fund allows investors to own 500 top U.S. companies at very low fees. Over decades, this simple approach has outperformed most active managers. Lesson: for average investors, passive investing is one of the safest and most effective paths to wealth. 6. Key takeaways from case studies: Buffett, patience and quality businesses. Lynch, invest in what you understand. Dalio, diversify across assets. Wood, embrace innovation. Bogle, keep it simple with index funds. Final thoughts on Part 14. Every investor has a unique style, but the common traits are discipline, research, and long-term vision. By studying these legends, beginners can adapt lessons to their own strategies and avoid repeating costly mistakes. Part 15. How to keep learning and improving as an investor. The stock market is always changing. New technologies, global events, and economic shifts constantly influence prices. To stay successful, investors must commit to lifelong learning and continuous improvement. 1. Read books by great investors. Some of the best investing wisdom comes from books written by successful investors. Recommended titles: The Intelligent Investor by Benjamin Graham, classic on value investing. Common Stocks and Uncommon Profits by Philip Fisher, focus on growth investing. One Up on Wall Street by Peter Lynch, how to find opportunities in daily life. Principles by Ray Dalio, insights on risk, diversification, and life management. 2. Follow financial news responsibly. Stay informed but avoid information overload. Trusted sources: The Wall Street Journal, Bloomberg, Financial Times, CNBC. Avoid social media hype that promotes hot picks without facts. Focus on long-term trends instead of reacting to every headline. 3. Learn to analyze data. Understanding financial statements and economic indicators improves decision-making. Study company balance sheets, income statements, and cash flow. Watch key indicators: inflation, interest rates, GDP growth, unemployment. Use free tools like Yahoo Finance, Finviz, or Google Finance for practice. 4. Join investment communities. Engaging with other investors helps you learn different perspectives. Online forums: Seeking Alpha, Reddit r/stocks, Bogleheads. Local investment clubs or meetups. Always verify advice before acting, never follow blindly. 5. Practice with paper trading. Most brokers offer paper trading or demo accounts. This allows you to simulate trades without risking real money. Great for practicing strategies. Helps build confidence before investing real capital. 6. Take courses and certifications. Structured learning can boost your skills. Free courses from Coursera, Khan Academy, Investopedia Academy. Professional certifications like CFA, Chartered Financial Analyst, for advanced study. 7. Review and reflect regularly. Review your portfolio and decisions. Ask yourself, what worked well? What mistakes did I make? How can I improve my strategy? Keeping a trading journal is highly effective for learning from experience. 8. Stay patient and curious. Markets reward patience, not speed. Curiosity keeps you exploring new strategies, industries, and global trends. The combination of patience and curiosity creates growth. Final thoughts on Part 15. Investing is not a one-time skill, it's a lifelong journey. By reading, practicing, joining communities, and reflecting on your progress, you will continuously sharpen your skills. The best investors never stop learning. Part 16, Final Summary and Motivation. You've now reached the end of this complete guide to investing in US stocks from AZ. Let's bring everything together and finish with the motivation you need to take action. 1. Key lessons recap. Part 1-3, you learned the basics of the stock market, types of stocks, and why US stocks are powerful wealth building tools. Part 4-6, you discovered how to open a brokerage account, analyze companies, and build your first portfolio. Part 7-9, you explored strategies, common mistakes to avoid, and the tools that make investing easier. Part 10-12, you walked through your first stock purchase, risk management, investor psychology, taxes, and regulations. Part 13-15, you expanded into advanced strategies, studied successful investors, and learned how to keep improving. Together, these parts give you the knowledge to confidently invest in the stock market. 2. Why long-term investing wins. The US stock market has historically grown about 8-10% per year. Short-term traders often lose money, but patient investors who stay the course build wealth. Time in the market is more important than timing the market. 3. Taking action. Knowledge is valuable, but results only come when you act. Your next steps: 1. Open a brokerage account if you haven't already. 2. Fund your account and start small. 3. Choose a diversified ETF or a strong company you understand. 4. Invest consistently, even with small amounts. 5. Stay disciplined, avoid emotional decisions, and keep learning. 4. The power of compounding. Albert Einstein once called compound interest the eighth wonder of the world. Reinvesting dividends and staying invested allows your money to grow exponentially over time. Example: invest $5,000 annually at 8% return. After 10 years, $72,000. After 20 years, $247,000. After 30 years, $566,000. The earlier you start, the more compounding works in your favor. 5. Final motivation. Investing is not reserved for Wall Street professionals. Ordinary people can build extraordinary wealth with discipline, patience, and knowledge. Don't wait for the perfect time. Start now, even small. Don't be afraid of mistakes, they are part of the journey. Remember, every great investor once started as a beginner. This guide has given you the roadmap to investing in US stocks from AZ. The next move is yours. Take that first step today. Your future self will thank you. And that wraps up our complete guide to investing in US stocks from A to Z. I hope this video gave you the clarity and confidence you need to start building your financial future. If you found this helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you never miss upcoming lessons on investing and wealth building. Thanks for watching, and I'll see you in the next video.